I'm going to do today a bit on VWAP and relative volume. These are a couple of things that came up in the chat. Now, I don't know everything about every indicator. I'm not going to profess to be an expert in VWAP, in its derivation, in every use that it has. Likewise with relative volume. I think this is the really important bit, and reading from the chat a few sort of comments on, it gets quite confusing, these things are quite complex. Yeah, they are. And if you get into the technical specifics of them, they can be. Now, I use VWAP, I don't use relative volume. I like the idea of relative volume, and I use something very similar, which I think does pretty much the same thing. But relative volume is really important because of the fact that it's very difficult to just look at volume and use that as a measure. What do you compare it against? Do you compare it against the last candle? Do you compare it against your personal basis of what a lot of volume should be? How exactly do you determine these things? So for those who don't know, VWAP's volume weighted average price. There's a complex equation. Essentially, average price times volume over average volume. The idea here is that a VWAP, rather than a moving average, gives you a little bit more accurate sense of where value is. A moving average merely works off a candles closed here, 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 and here, and you're going to get an average price somewhere in the middle of them, which continues to move because what happens is it cuts off the last one and then averages the next 20, then cuts off the last one and averages the next 20. But it doesn't take account of what's actually happening, whereas volume weighted average price does. It takes account of the amount getting traded, so theoretically should give you a better judgment of where value is. Now, the reason this is important is from a more investing type sense, and I know there was a mention of mutual funds being involved in these types of things and it being used in a lot of algos, and a lot of that is true. You're never going to know what algos use it and how they use it. And that's another important thing, that trying to dig too much into those kind of things, the specifics and the known unknowns, if you will, you're never going to be able to find the answer to that, and it's always going to evolve. But what you've got to think about is, essentially, if you have a VWAP like this zone up here is deemed good value to sell. If you can sell anything above the VWAP, that seems like good value. If you can buy anything below, that seems like good value, and that's the judgment of value. So in a sense, the further you can get away from VWAP, the better a buy that is perceived to be. Now, the difficulty with that version or that way of looking at VWAP is, well, yes, let's say we're 50 ticks below VWAP. That looks like a good buy. Let's call that a 50% discount on something you want to buy. Yeah, that looks like a good deal. But it could also go to 75. And so then, or let's say 75 ticks below VWAP, well, it's an even better deal. But how far can you keep on buying that as a mean reversion trade? It's quite a tricky trade to actually take, and there's many examples. If you go and put a VWAP on, particularly a very strong trending day, it doesn't come back to it at all. Where I think is really important with any indicators, anything like this, is working out when you best use it, when you feel that now's the time to use it. Because I think anything that just works from an indicator and says, let's say, for example, there's your VWAP, every time we hit it, I'm going to sell it, or every time we hit it from the upside, I'm going to buy it, and looking for that type trade. Well, that's fine, but you'll get days, and if anyone's got a DAX chart up at the moment with a VWAP on it, got a cable chart up at the moment with a VWAP on, you can see it's gone across it all day long. If you'd taken that strategy, you'd have got burnt. The key thing with any indicator is working out when to use it, when it's worth using it. Likewise, relative volume. And what I'll do is I'll talk you through a couple of examples sort of a specific way that I think can be used. This is not an exhaustive, this is how to use it. You need to work out your own way of using it. Some people prefer to use it as a target. If you get in, the VWAP becomes a target to get out of the trade. Personally, I'm more inclined to use it for continuation, so I'll talk to you about that in a moment. Relative volume, the idea here is it's giving an indication of strength, and more so than volume. Because if you get a candle that goes up and you look at that and go, oh, that's got high volume compared to the candle before, and your volume histogram looks like this, and you've got this one there, high volume, and you're thinking, oh, big volume, this is good. Well, yes, it may be, but if this has been a really low volume period just beforehand, this isn't very significant. This could just be a few people more than is currently trading. So what's important, and this is where relative volume helps, is gives you a strength of and a more visual representation of relatively how good it is. Whenever you're considering volume, it's not about absolute numbers, it's about relative to what's been going on. If you've got a quiet day, it's not going to take much to look like you've got higher volume. And for that day, it is higher volume, could provide a bit of movement, but likely a quiet day produces less move. So let's say you've got a low volume day and you're in the S&P in a 10 handle range, and you suddenly get one candle with much more volume. Yes, it may move, but you're not going to see that initiate a 50 handle move. It's more likely to initiate an extra 5 out of the current range, let's say. So the idea here is it allows you to filter your trades. It allows you to say, right, relative to the last few days, the last week, the last however many periods you want to judge it by, now I've got a bigger opportunity, and this is confirming it. I'll show you this using something that I use. Now what I use is an average volume per time period. And what this does is it doesn't give you a relative volume. Relative volume basically gives you a ratio of average volume over current volume, or current volume over average volume, I should say. So let's say, for example, your average volume for midday to 12:15 is 20,000 lots. If all of a sudden your market is now traded 100,000 lots, you would have a relative volume of 5 times the average. Now, I haven't got relative volume on my charts. Instead, I've just got an average over the last 10 days of what volume has been at a specific time period. If you see it rising above that, it's giving you a clue that relatively we're now seeing more volume going on, gives you a chance to have a little bit more conviction. The other point that I made at the beginning, don't overcomplicate it. That's your VWAP equation, and you can go into the details of how you're going to derive it, and if you want to know how to program the creation of a VWAP, fine, you might need to know a little bit more detail, but you don't need these details all the time. What I've also got there is the equations for Newton's second law of motion. Now, you don't need to know calculus and understand differentiation to know that if you've got a large object, if you want to move it, you're going to have to push that harder. And that is essentially Newton's second law of motion. That you need more force to create an acceleration if your mass is larger. Everyone knows that from experience, that you can push a small toy car with relative ease. It's going to take 2 of you to push an actual car, assuming the handbrake's off. So don't overcomplicate, don't look into these things more than you need to. And also, I'll give you an example here, when to use it. And it's about learning when you prefer to use it and how you're going to use it. For me, my favourite use of a VWAP is for what I call a passive continuation trade. Now, what I've got here, 5-minute chart of a move down. This is an example in the Bund, I'll give you one in the Dax in a minute. And what you're looking at here, now, one of the important things for me, and something that what I'm looking for often with any trade is a clue. Something that says to me, today might be the day for it. And this comes with a gap. I often find that on the back of a gap, you get VWAP reacting more and providing you a chance to get into a trade for a passive entry. So what I'm looking at here, criteria for it, an impulsive move away. So once you've got that gap, the market then runs with it and pushes. That's the first thing I want to see. So straight away from there, take the VWAP away. I'm already looking at this, and I'm sure many of you heard me talk about this before. There's a little patch of low volume there. I'd be looking at that thinking, yes, I might want to be short around there. Then you've got the VWAP, which is this little sort of staggered line coming down. It's staggered because it is redrawn each time period. VWAP coincides, and if it's got any kind of confluence with another level, perfect, that's what I'm looking for. You're using it then to play a passive entry for a continuation move. The first one I would actually suggest doesn't quite work. Once you break this low here and start coming back, I'd say that this initial flag has not worked. You then get a second chance, which you've still got the safety of this low volume above for a stop, to play again another passive trade, this time looking for this new flag to break of this low, which is what I would call your trigger point, and at that point your conviction should then be new lows are coming. That's one way I like to use it. So it's a way of holding on to a trend, or a way of getting into a trend. Now think about the mechanics of this a little bit here, and I'll give you this on the next one as well. So here we are, we've actually got a gap up in this instance, and the gap up immediately reverses and the market starts to run lower. This is a slightly more steady down move, but what the point here is think about if you wanted to sell above VWAP. You've got a gap up and you're thinking, oh, this could be good value, that I'm going to be able to sell above VWAP all day and we're going to get better and better prices to sell at. What happens? Market turns around, drops, gets a little bit of a drive away at the beginning of the cash open. Not a huge drive, but it moves lower, at least it's quite clear previous lows, which we then come back and test. That's the bottom of the initial balance. Now, if you thought that you're going to be able to sell above, now you're not. Market's holding below. So if you were looking to sell it higher up, well, now you've got a situation where perhaps the best price you're going to get is the VWAP. So the sellers who were all waiting up here, maybe now start thinking, well, and take it from the idea of a sporting match. The chance of a win is looking very low at the moment. So what's a better choice? A loss or taking a draw? At least you've got VWAP. And if you're looking to say a client, you can say, well, we got your price at VWAP. And throughout the day, that was about the best you could get if you were looking to sell. So that's another way of looking at it. And that's partly why you then get the VWAP reacting. Market comes back to it, and the sellers who were looking to sell it above come down to it. They're more eager to come closer to VWAP because they're getting less chance. This then helps propel the move lower. Another area that I really like, and I'll give you this on the DAX as well in a moment, is the little break of a level. This is a steady move down. It's not the most dramatic move. And this is quite a clear area here where people are going to look to sell it from. We get a little break lower, market starts to pull back. People are going to come and sell it there at 171.97. Potentially, with a very tight stop above. Now, what the VWAP's giving you is, one, a bit of stop placement, but also, for any continuation move lower, you're often looking for a little test up before it goes down. That's what you get here. Market gets back to level, little spike through. You can be ready for that, and you can be sitting there potentially with an offer at that VWAP for that passive entry. You get that flick up, a few people get stopped out, and then you sell. Or you get filled on the stop, and then the market comes back up. That's how I'm looking to use these types of things. That it's about using it in specific moments, specific times. letting the market show you a bit of a clue. Once it's given you that clue, then you can start to run with it a little bit. Give you another example of that little spike. This was one in the DAX. Again, another gap, impulsive move away. This is where straight away you're thinking, okay, we could be on a bit of trend move. This was last Friday. We could be on a bit of trend move, a bit directional today. Market starts to consolidate just here. Nice little flat bottom here of this consolidation. So you've got a reason to be, you can't be sure, but you can be thinking there's going to be a lot of people just buying it here for the continuation. You may get a few little stops lower. That can give you the chance to buy the VWAP. It's already clearly moving higher. We have had a gap. We have had the impulse move up. Now you can look for the VWAP to take as a trade. So it's about using it for a specific, using it for a certain setup, a certain way of playing a move. For me, it's the passive continuation that I like for a VWAP. Often what you do need to remember with this is it's a passive trade. This isn't going to hit VWAP and go boom, straight line up. It's probably going to be a much more steady move, and we've seen that on each of those previous examples. It may accelerate once it gets past a certain point, but initially it's going to be a likely steady move. Right, let me give you a little bit on RVOL. So relative volume. What I have on my charts, and I know you can get this on Sierra as well if anyone's using Sierra, is this little blue line which gives you the average volume for that time period over the last 10 days. Now, what we've got here, I've boxed off a couple of areas where you actually get a bit of movement, but it's all about this volume picking up. So you can see that clearly volume is way above the average there in the S&P. Way above average volume for this time period. This is around about 6:15. Market starts to move. Now you've already been seeing this move higher. You may well have a little trend there. As it picks up volume on that break, that's where you can start having confidence that with this increase in volume compared to average, this is more than a normal move. There's scope for this. There's a chance for us to reverse all the way back down the move. Once you get back inside this initial range and volume is still staying high, you've got confidence to stay with that, rather than just purely exiting or just purely thinking, oh, well, the move's happened, that's it. Because if you don't have an indication or a way of filtering whether this is bigger than normal, you don't know whether that's actually high volume or whether it's a little bit of an increase in volume, but it's nowhere near as much as a close. It's nowhere near as much as you got in the first sort of half an hour, 45 minutes of trade either. Again, another example here, and this just giving you a little bit of clue. You don't get a huge move here, but the selling volume is much higher than the buying volume. This little sell here is reversed, but look at the relative volume. Above average volume on the selling, below average volume on the buying. Next time the selling starts, and we're still in this little range here, selling begins, above average, excuse me, comes off, gets below this recent low, then you get the volume continue to pick up and the sell-off continues. So it's all about being able to say, yes, this is a more significant move. This is more significant action as opposed to, okay, we're seeing a little bit of volume. So it gives you a little bit more context to your volume. Another way of using it is to prevent you getting overly involved. Look here. What this is indicating to me is a complete lack of energy. And you can see in both these 2 days, they're both pit sessions, you're getting 8, 10 handle range, that's around about it. So even when you do start getting movement going into the close, not once does it get above the average volume. Okay, slightly going into the very last 5 minutes of the day, but it really struggles to get above average volume. That's an indication that you probably don't really want to be getting involved here. This day after the initial, and we get a few little spikes in volume here as you get market moving up and down range, all on sell volume as well, again. But very quick, volume falls off. This move then is a very difficult move to trade, very little happening. The next day, same theme as well. showing that the market really doesn't have a great deal of interest. You get one little peak above average volume just here. This is one attempt lower, doesn't get any traction, no increase in volume on the move back, and extremely flat. The last few hours of the day sitting around about a 4 handle range for a full 4 hours. So very, very steady trading. So what it does, it allows you to have conviction on this is a move that's actually potentially got more in it, rather than, you can see there's low energy. This then gives you more confirmation. It's just an extra tool to give you a little bit more conviction, a little bit more clarity as to what's going on. That, I think, is the way to be considering, particularly RVOL. Don't overcomplicate these things. Find a way that it gives you a trade opportunity. And that all comes down to going back over when you saw a move. How did it react to VWAP? What were the criteria that happened before? When is it more likely to react to VWAP? They're the important things. So it's marrying up the current market theme, context to what's going on now, and how you can play that trade, rather than trying to find a sort of one-size-fits-all rule that you can play a VWAP trade every day. Chances are you can't. It may well come up once or twice a month, 2 or 3, 3 or 4 times a month. But when it does, you know the trade. And that's the whole idea about building up patterns, building up ideas. RVOL, you could be using it almost every day as a way of filtering back away from trades or more into trades. Right, I'll wrap it up there for you guys. I'll be back on later. We'll do Bank of England rundown, so I'll see you all there. Bank of England could, for the first time in around about 2, maybe even 3 years now, be looking pretty interesting. 2.5 years, I'll say.